Imagine for a second, right, that you run a modern, highly successful business.
Okay, I'm picturing it.
And you've spent, I don't know, the better part of a decade telling your investors, your board, basically everyone, that digital growth is your absolute superpower.
Right, the classic modern tech pitch.
Exactly. You are digital first. You are mobile first. Your entire customer acquisition strategy is built around this slick app.
Yeah,
And then on just like a random Tuesday, the government walks right into your headquarters, functionally unplugs your servers, and says you cannot use the internet to get new customers for almost a year.
wow. Just a total shutdown.
Period. Hard stop. I mean, how does a company actually survive that? Honestly, if you look at the landscape of modern business, most companies, they wouldn't. They would just bleed out.
Oh, it would be a catastrophic death spiral for a lot of modern franchises.
Yeah.
I mean, when you abruptly sever the primary artery for growth, panic usually follows.
Yeah, immediately.
The market loses faith, internal teams start pointing fingers, and your competitors just instantly start poaching your target demographic.
Well, welcome to the deep dive. Today, we are pointing our lens at a real-world scenario that played out, well, almost exactly like that. We're talking about Kotak, Mahindra Bank, or KMB.
It's quite the story.
It really is. And we are on a mission today to unpack a stack of very recent, very revealing sources that you brought in for us.
Yeah, we've got a lot of ground to cover.
We really do. We have their Q3 FY26 investor presentation, so that covers the period ending December 31st, 2025, along with a pretty comprehensive 12-month news analysis. And to top it off, a detailed technical stock chart that brings us right up to the minute here in March 2026.
The narrative arc that is buried in these documents is genuinely incredible. I mean, we are looking at a massive financial institution that went through a brutal roller coaster over the last couple of years.
Brutal is right.
Yeah, they faced intense regulatory scrutiny, a massive operational embargo, and on top of all that, a fundamental DNA-level shift in their leadership. And all of this is compressed into a very tight time frame.
Which is wild. So our goal today is to help you, the listener, navigate how they transition from that dark, really uncertain period into this aggressive new phase of resilience and recovery.
Right.
Okay, let's unpack this. We have to start with the elephant in the room. The U-turn year. Because what happened to Kotak? It wasn't some minor regulatory slap on the wrist.
No, not at all.
It wasn't a fine that they could just write a check for and make disappear.
It was a systemic shock to their entire operational model. From April 2024 to February 2025, the Reserve Bank of India, the RBI, issued a cease and desist order against the bank.
A full cease and desist.
Completely. They were unequivocally banned from onboarding any new customers through their online and mobile channels.
Wow.
And furthermore, they were banned from issuing any fresh credit cards.
I mean, this is like a major retailer being told, hey, you can keep your physical brick and mortar stores open, sure, but you have to completely shut down your e-commerce website.
Yes.
Oh, and stop issuing your customer loyalty cards right before the holiday shopping season.
Oh, that's a great way to put it.
And the stated reason in the news analysis we read was serious deficiencies in IT governance. So basically, the regulator looked at their tech infrastructure, saw, way too many outages or vulnerabilities, and decided the system just couldn't handle the scale.
Right. The RBI essentially said, your pipes are leaking, stop pushing water through them.
Exactly. But in a digital-first banking era, where literally everyone is acquiring customers through slick apps, how does a bank not just entirely collapse during a 10-month digital embargo?
Well, when you read the headlines from early 2024, the sentiment was highly pessimistic for that exact reason. People assumed the growth engine was dead.
Naturally.
But the answer to their survival, it actually lies in the underlying, often unglamorous resilience of their core traditional franchise.
The brick and mortar.
Exactly. The digital pipeline was bolted shut, sure. But their existing physical branches, their corporate lending divisions, their commercial banking relationships, all of those engines had to go into absolute overdrive.
So they essentially had to rely on old-school shoe leather banking.
Yes, precisely. Relationship managers had to hit the pavement. Instead of relying on an app to bring in, thousands of retail accounts a day, they had to pivot.
Right, they had to go to the people they already knew.
Right. Deepening the wallet share of their existing corporate clients. They cross-sold aggressively to the people who were already in their ecosystem.
That makes sense.
And crucially, they didn't just sit around and wait out the clock on the regulator's ban. They initiated a massive, comprehensive external audit and just completely overhauled their IT remediation.
So they had to rebuild the airplane's engine while it was still in the air.
A perfect way to visualize it.
Yeah.
I mean, they were spending massive amounts of capital and human resources to fix the back-end infrastructure while simultaneously trying to keep the front-of-house operations looking perfectly smooth to the market.
Which sounds exhausting.
It was.
Yeah.
And the payoff finally arrived on February 12, 2025. After passing that external audit, the RBI officially lifted the ban. Yeah, and that single event has been the biggest catalyst for operational sentiment over the last year. It proved they could survive the absolute worst-case scenario and actually appease a very, very strict regulator.
Okay, survival is a great story, but thriving is what investors actually care about, right? To see the actual financial impact of running with a hand tied behind their back for 10 months, we need to look under the hood of their latest earnings report.
Q3 numbers.
Yeah, the Q3 FY26 report card. I'm looking at these consolidated numbers, and frankly, I need you to translate the damage for me. So they lost their main growth engine for almost a year. How ugly did the Q3 earnings actually look?
Well, what's fascinating here is that the numbers tell a very different story than what a crisis year usually looks like.
Really?
Despite the ban for the quarter ending December 2025, Kotak posted a profit after tax equity of 4,924 crore.
Wait, 4,924 crore.
Yes, that is actually up 5% year over year.
Okay, that's wild.
Total customer assets hit a massive 598,780 crore. Customer deposits grew by 15% to 542,638 crore.
Up 15% without the app.
Without the app. And net advances, so the actual money they are lending out to generate interest, are up 16% to 480,673 crore.
Wait. They grew their lending and their deposits by double digits without their primary digital acquisition tool.
They did.
That's almost unbelievable.
It is impressive. And what stands out even more is how those growth metrics actually translate into profitability. Because look, any bank can grow deposits if they just pay ridiculously high interest rates.
Right.
Right.
But that ruins your margins.
Exactly. It ruins profitability. But if we look at Kotak's ROA, their return on assets, it sits at 2.10%.
Yeah.
Their ROE, return on equity, is 11.39%.
Let's pause on that ROA for a second, because 2.10% sounds like a tiny number to someone outside of finance. Like, I wouldn't get out of bed for a 2% return on my savings account. Why is that a metric they're putting front and center in their investor presentation?
Context is everything here. You have to remember, banks are highly leveraged institutions. They take in deposits and lend them out, making a tiny spread in the middle. Because of that immense leverage, a typical healthy bank might hover around a 1% or maybe 1.2% return on assets.
Ah, I see.
Yeah, breaking the 1.5% barrier is considered excellent. Pushing past 2% ROA, that is the hallmark of an incredibly efficient, highly profitable machine.
So they aren't just surviving, they are actually crushing it.
Exactly. What this 2.1% proves, fundamentally, is that their traditional non-digital avenues held the fortress perfectly. The physical branches carried the weight of the entire bank and did it highly profitably.
I see the strength there, absolutely. But I'm also spotting a couple of very interesting wrinkles in this data you brought.
Oh, like what?
Well, first, their net interest margin, the NIM, it actually compressed. It went from 4.93% down to 4.54% year over year.
True.
And second, as I dig through the profit and loss statement, there is this highly specific kind of random 98 crore post-tax hit explicitly called out for a new labor code.
Right, yes.
Can we break those two things down? Like, what is going on with that labor code hit? That seems so random.
You've zeroed in on the exact pressure points the bank is facing right now. Let's tackle the labor code first because it's a really great example of the hidden costs of running a massive corporation in India right now.
Okay.
The government has been rolling out these new national labor regulations that redefine how basic pay is calculated.
Meaning the math actually changes on how they have to compensate their employees?
Yes, specifically regarding long-term liabilities, things like provident fund matching and leave encashment. When the legal definition of basic pay expands, the bank suddenly owes more into these employee retirement and benefit pools.
Ah, so it's a retroactive bump in overhead.
Exactly. That 98 crore hit is a direct, unglamorous cash accounting adjustment just to comply with the new law. It eats straight into their operating expenditure.
Ouch.
And keep in mind, they're taking this hit at the exact same time they're carrying the heavy financial weight of their massive IT remediation.
So they're rebuilding the tech stack while the government completely changes the payroll math.
Right.
Okay, that explains the expense side. But what about the NIM compression? Why is their margin shrinking if their loans are growing so fast?
The NIM compression is a classic symptom of the current macroeconomic environment. That margin shrunk because the cost of funds is rising across the entire banking sector.
Because rates are up.
Exactly. Everyone is fighting for deposits right now. Kotak has a healthy CASA ratio, so that's current account and savings account ratio of 41.3%.
And those are the cheap accounts for the bank,
Right.
right?
Those accounts pay very little interest to the customer, so it's cheap funding.
But I'm guessing customers are getting smarter and moving their money out of those low-paying accounts.
They are migrating to high-yield term deposits or fixed deposits. Customers see inflation, they see higher interest rates out there, and they want better returns on their cash.
Which forces the bank's hand.
Exactly. So to keep that 542,000 core deposit base from fleeing to a competitor, Kotak has to offer higher interest rates on their fixed deposits. Their cost of funds goes up, which squeezes that margin from 4.93% down to 4.54%.
Makes total sense. So they're navigating the friction of compliance, and they've got this fierce competition for deposits. But then, and this is what's crazy, I get to this other metric in the presentation, and it totally reframes the conversation for me.
The SOKR.
Yes. Their capital adequacy ratio, the SUKR, is a staggering 23.3%. And their CET1, which is like the highest quality core capital, is 22.4%. Now, I know the regulatory requirement in India for CORPR is usually somewhere around 11 or 12%, right?
That is the regulatory floor, yes. Usually around 11.5%.
Which means they're sitting on a literal mountain of cash. They're overcapitalized to a degree that almost seems inefficient. They're holding twice the capital they legally need to.
It's a massive war chest.
Which leads us to the strategic pivot. Because cash sitting idle doesn't generate massive returns. They're functionally forced to deploy this, which means the new leadership team isn't just arriving at a good time, they're arriving with a clear mandate to spend.
This is where the story shifts from just a regulatory recovery to a massive cultural transition, the Vaswani era.
Right.
For decades, Kotak Mahindra Bank was essentially synonymous with its legendary founder, Uday Kotak. I mean, he built it from the ground up.
He was the bank.
Exactly. But recently, we saw the transition to a brand new CEO, Ashok Vaswani. And the 12-month news analysis we look at explicitly describes this new leadership team as younger and hungrier.
Changing the C-suite of a founder-led bank has to be incredibly delicate.
Oh, it is the defining tension of Kotak's future right now. The analyst reports outline a classic bull versus bear case regarding this transition.
Give me the bear case first.
The bear case. The inherent risk centers entirely on leadership attrition and cultural friction. A founder-led environment operates with a massive amount of institutional memory. It can sometimes feel almost like a family, driven by the intuitive decisions of the person whose name is quite literally on the building.
And Vaswani is coming from outside that bubble.
Right. Moving from that into a global professional culture, which is far more process-driven and scale-oriented, is jarring. The news analysis already notes some senior-level exits. Maintaining stability when you're fundamentally altering the DNA of the executive suite is notoriously difficult.
But the opportunity, the bull case, seems to dwarf that risk if they can actually pull it off. Because here's where it gets really interesting. The sources quote Vaswani as being openly ready for jumbo deals exceeding $1 billion.
Yes.
He has that massive war chest of capital from that 23.3% CAR, and he is hunting.
The question then becomes, what do you buy with $1 billion when you are already a massive systemically important bank?
Well, the sources point to prime acquisition targets in either the microlending space or wealth management, which makes a lot of sense, right?
It does.
Microlending offers those high-yield returns that can help fix that compressing net interest margin we just talked about. And wealth management requires very little capital but generates steady, lucrative fee income.
A perfect complement to their current structure.
Exactly. Plus, with the RBI ban finally lifted, they aren't just looking outward, they are aggressively reinvesting in themselves. They are completely relaunching their digital 811 app to capture those affluent retail customers again.
And their timing on this aggressive expansion might be incredibly fortuitous.
How so?
Well, if you zoom out from the bank's internal metrics and look at the macroeconomic tailwinds mentioned in the reports, the RBI has recently shifted to a neutral or accommodative stance. They've adjusted repo rates down to 5.5%.
Okay, the RBI lowered rates to 5.5%. But if Kotak is already sitting on a mountain of unspent cash, why do they care about cheaper borrowing costs from the central bank? I mean, they don't need the money.
They don't need the money for their own liquidity, no. But their corporate clients do. Lower borrowing costs stimulate the broader economy. When the RBI drops rates, it gets cheaper for manufacturing firms to build new factories or for everyday consumers to take out mortgages.
Right, it unlocks spending.
Exactly. It positions the entire banking sector for a massive pickup in credit demand. Just as Kotak is relaunching its digital acquisition tools and looking for billion-dollar acquisitions, the broader market is being incentivized to borrow again. They have the dry powder to meet that sudden surge in demand.
Wow. The macro environment and the micro strategy look perfectly aligned. We have a bank that survived a near-death digital experience, posted rock-solid profits using their physical network, installed a new CEO with $1 billion in spending money, and the macro economy is shifting right in their favor.
It's quite the setup.
So how is the actual stock market digesting all this potential? Because I was looking at the technical chart you brought, and the numbers require some serious translation.
Let's pull up those technicals. We are looking at a daily candlestick chart for Kotak Bank, stretching right up to March 2026. First, there's a critical piece of context that explains the share price. The stock had a 1-to-10 stock split in 2024.
Okay, meaning if you owned one share at 4,000 rupees, you suddenly own 10 shares at 400 rupees. The total value of your investment didn't change, but the stock looks cheaper to a retail investor.
Correct. Companies do this to increase liquidity and make the stock psychologically more accessible to everyday traders. So looking at the chart today in March 2026, the price is consolidating in a very tight range, right between 390 and 410 INR.
Yeah, I see the chart forming a very specific shape here.
Yes, in technical analysis, this is known as an ascending triangle.
Walk me through the psychology of that. Why does a literal shape on a chart tell us what investors are actually thinking?
Think of it as a visual representation of supply and demand aggression. The stock has a flat ceiling strict resistance at 410 INR. Every time it hits 410, entrenched sellers dump their shares, which caps the price. But the floor keeps rising. The stock has a dynamic support level around 390 INR, which is bolstered by the 50-period exponential moving average.
Meaning every time the stock dips, buyers are stepping in earlier and earlier to scoop it up?
Exactly the psychology.
Yeah.
The buyers are showing urgency. They are willing to pay higher lows, while the sellers refuse to budge from the ceiling. It creates a pressure cooker.
I can see that.
Furthermore, when the stock rallies toward that 410 ceiling, we see volume spikes. The big money institutional investors is buying those rallies. But during this recent sideways chop, the volume is very low.
Like everyone is just waiting.
The market is holding its breath. A breakout above that 410 resistance level on high volume would signal that the buyers finally overwhelmed the sellers, indicating a massive continuation of the overall uptrend.
The technical setup makes total sense, but I have a major problem with the fundamental data provided in our sources here.
Uh-oh. What is it?
There is a wild, glaring discrepancy that is driving me crazy. Let's call it the paradox of the target price.
Okay, I think I know where you're going with this.
Right. The technical chart shows the stock hovering around 400 INR post-split. It's bouncing in that pressure cooker between 390 and 410. But the news analysis explicitly notes that the analyst consensus is giving a target price for December 2026 of 2,400 to 2,600 rupees.
Yes, that is quite the gap.
I mean, how do we square a 400 rupee reality with a 2,500 rupee expectation? Are the Wall Street analysts just mathematically confused by the stock split?
It is the defining paradox of this entire data set, and it really requires careful synthesis. There are two realistic interpretations for a gap that massive.
Okay, give me the first one.
The first is indeed a data lag anomaly. It is highly possible that some of these aggregated target prices reflect old pre-split psychological anchoring.
Interesting.
Sometimes consensus data aggregates poorly on financial portals after a major corporate action like a 1-to-10 split, and the automated models just haven't fully normalized to the new share structure.
So literally a glitch in the matrix of financial reporting.
Essentially, yes, a failure of data aggregation. But the second interpretation is much more profound, and it ties back to literally everything we've discussed today.
Okay, what's the second option?
If we assume those targets are intentionally adjusted and accurate, they represent a truly astronomical growth expectation based on a fundamental re-rating of the stock.
Let's quickly define a re-rating for the listener. This basically means the market is entirely changing the multiple they're willing to pay for Kotak's earnings, right?
Yes. For 10 months, the market was pricing the stock as if the RBI ban was a permanent existential threat to their growth. The multiple compressed.
Because the risk was so high.
Exactly. But now that the regulatory overhang is gone, the market realizes the core banking engine is wildly profitable, the digital doors are back open, and there is a billion-dollar war chest ready for deployment.
So the sentiment shifts.
Right. A re-rating means investors are willing to pay a massive premium again because the risk profile has drastically improved. But, and this is a massive caveat, hitting anywhere near those bullish expectations requires absolutely flawless execution of Vaswani's strategy.
Right. They can't just be a safe, boring bank anymore if they want that valuation.
No, not at all. They need sustained, aggressive double-digit loan growth. They need successful integration of their newly rebuilt digital systems. And they need that massive M&A capital to be deployed perfectly without destroying the balance sheet.
They have to prove they are an apex predator in the market again, not just a survivor.
Precisely.
So, to synthesize this entire journey for you listening, Kotak Mahindra Bank took a regulatory hit that would have severely damaged or honestly even ended a lesser institution. They essentially had their modern digital doors forcibly nailed shut by the government, but they used their traditional physical banking muscle, their relationship managers, and their corporate ties to maintain double-digit growth and high profitability. And now they've emerged on the other side. They have passed the audit, they have a new leadership team, and they are holding enough capital to potentially reshape the entire Indian banking landscape.
If we step back and look at why this matters to you, whether you are an investor looking at emerging markets, a business leader managing a transition, or just someone interested in how resilient systems function, Kotak is a masterclass in the value of underlying fundamentals.
It really is.
We live in a business world that is utterly obsessed with fast, frictionless digital growth. But when your shiny digital storefront is forcibly closed, the quality of your core assets is the only thing that saves you. Look at Kotak's gross non-performing assets, their GNPA.
Which is incredibly low, right?
It sits at just 1.48%. Their loans are safe. The money they lent out is actually coming back. Their foundation was solid rock, even when their digital roof temporarily caved in.
It really is a testament to building a business that can survive its own worst-case scenario. But as they pivot from that defensive survival posture back to an aggressive growth mandate, I want to leave you with a final thought to mull over.
Let's hear it.
When a massive institution transitions from a legendary founder's DNA, the Uday Kotak era, to a global professional corporate expansion under Ashok Vaswani, does that original foundational culture serve as the bedrock for the future? Or does it inevitably clash with the new mandate for scale and acquisition?
That is the billion-dollar question.
Keep a close eye on the internal culture of this bank, because as they deploy that billion-dollar war chest, culture might just be the one vital asset that money simply cannot buy.